Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have a great guest, but first, a quick chat about goal setting. Goal setting is one of the most important aspects to achieving anything in life. If you don't know where you're going, you might end up someplace else. I'd like to invite you to join me for 3 days on the Mexican Riviera for an intensive goal setting retreat so that you start your 2020 with energy, purpose, focus, and momentum. The annual goal setting retreat will take place over the first weekend in December. Registration is now open. You can register directly at victorjm.com/events. That's victorjm.com/events. Or send an email to goals@victorjm.com. That's goals@victorjm.com. We are back here on the weekend edition. We interview notable people from the world of real estate investing. Today is no exception. We have an amazing guest all the way from Long Island, New York. Welcome to the show, George Ross. Good evening, George.
Hi there.
George, of course, was Mr. Trump's right-hand man for most of 37 years. Definitely take your pen and pencil out, take lots of notes. Let's dive right in, George.
Yeah, but first of all, I was with Trump for 47 years.
47.
You knocked off 10 years?
I must have.
Go ahead.
Maybe you're 10 years younger.
Wishful thinking.
So, George, one of the things that's in the news today, prosecutors in Germany brought charges against 3 senior executives from Volkswagen, current CEO, the former chairman, and the former CEO. In fact, the current CEO only joined the company in 2015, and he only took over as CEO in 2018. And this all has to do with the diesel emissions cheating scandal that affected Volkswagen. And in their surprise indictment, the prosecutors argued that executives withheld information about the scandal from shareholders in an attempt to prop up the share price. And it shines a spotlight on the fiduciary responsibility that any sponsor has to investors to disclose even bad news. What's your perspective on this story and in general how to handle bad news?
Well, that's a very good question. First of all, you have to make a distinction between a public company where there are independent shareholders and the stock is readily marketed back and forth. That makes a big difference because there's a greater fiduciary responsibility for when the CEOs or people know something, an obligation to disclose it to the stockholders so that they can make a decision one way or the other as to what they want to do with the stock. That doesn't necessarily follow where you have no public issue and no stockholders of consequence, and there's no generally open market. But it is a good practice for any sponsor or someone, when there is bad news, at that point, come out with it and tell the bad news, whatever it is, to the participants and to the investors. They like that, the fact that you told them. If they find out that you held something back, it is much worse. You lose a lot of credibility at that point. If you knew something that was negative and you held it back, that is much worse at that point than telling it as you think it is, or where you can flavor it to make it not as bad as they might think it is. But bad news is good to disseminate. It's good practice.
Now, in this particular case, part of the thing that would have affected the share price is the close to $30 billion in fines and penalties and so on that were paid to the U.S. government. And obviously that has an impact on earnings and the shareholder value.
Absolutely.
But at that time, it wasn't known what those fines were going to be until they were announced. So it really was only a risk at that point. It wasn't news per se.
No, that's a very good point. At what point are you obligated to make a disclosure? And that is a very slippery slope. Certainly, make a disclosure when you have a suit and it end up with a liability of many millions or billions of dollars. Then it's a little on the late side. The fact that the suit was commenced and is in existence is something that should have been brought out. And then you say, fine, we have the following lawsuit. This is what they're seeking and how much damages or whatever it is, and let the stockholders can know that this is oncoming and they can act accordingly. So it's a question of when to disclose it and how serious it is. There's no finite decision to be made or time. It's just when it gets to the point that you think there's a likelihood or a good possibility that it could have a severe adverse effect on your company. And that's a call. That's a judgment call.
So for us as investors, as deal sponsors, where we're maybe bringing in investor capital, what's your guidance? What's been your experience?
Well, the guidance is at this point, it depends on when you know something. If you get hit, if as a sponsor, you get hit with a major lawsuit, then you come out and you tell your stockholders or your investors, this is there. We don't think there's substance to it, or we think that there is some. You can evaluate what you think it is, but to come out and disclose it, I think is important and certainly good business practice. Because if you don't, and later it comes up, and somebody says, "Well, why didn't you let me know?" And what's your answer? I didn't think it was that important. Well, you should have thought. You're making a decision. It's a tough call, but I think I would certainly go along with the idea of more or fuller disclosure than withholding information on the possibility that it might be negative.
That makes sense. That makes a lot of sense.
Yeah, but it makes sense because it's easy in the when you're talking in the abstract. When you're down, and then when you're talking when you're involved and you got the investors and they're scary, or the property, there are other problems that are involved in connection with the particular investment. Then to throw another bad element on it at that point, is not a great idea. You're putting oil on a fire. So it's a judgment call.
I mean, I'm sure you've encountered numerous situations where you or your clients might have received a threatening letter or who knows what, and in the end, nothing came of it. Would something like that merit warning investors about or not, in your opinion?
No, what? A letter? No. No, I think there has to be an evaluation, but in this instance, when you have with Volkswagen, it's an entirely different thing. It was more than a letter at that point. There was a lawsuit going on.
Of course.
And which is a substantial lawsuit. But any big executive or any big company can get hit with a whole bunch of potential lawsuits with you have somebody claiming anything that could be a potential liability. And it's up to the people in control as well as counsel to make a decision as to how likely this is to have an adverse effect on the company and when. It's in the former stages. If it's after trial, that's fine, but there may never be a trial. So it's a judgment call. It's when to release it or if you should be releasing it. And you can't write any hard and fast rules for that.
So there you have it, from someone who's been in the business for over 60 years, from Mr. George Ross. If there's a question, you definitely want to err on the side of disclosure. If you fail to disclose, you could be opening yourself up to a tremendous amount of liability. It's a fiduciary responsibility that you have to disclose bad news. Disclose, disclose, disclose. As you think about that, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.